Good afternoon. Welcome to the Ignite Hub. My name is Eduardo Noboa. I am the Technical and Training Development Coordinator. I'm joined here by my colleague, Anthony Fiora, the Lab Coordinator as well. Thank you so much for being here, both to our guests that are here at the Hub in person and the guests who are joining us online as well today. It is incredible, but today we are having the last of the Future of Techs for Spring 2025. It's been a great season. I think that we have a great speaker today to just close it with a bang. And we are, just so you know, we have already lined up most of our guest speakers for the fall 2025. So just continue, monitoring your emails, and we will start putting that up as soon as we have more information. But again, thank you for being here. So today, it is my pleasure to introduce our guest speaker, Ms. Kelly Dominic Hudson. And Kelly Dominic is the Chief Compliance and Innovation Officer of Peridom Insights, a woman-owned health equity firm in Montgomery County, Maryland. Peridom Insights empowers communities to break barriers to health equity through cultural competent training, artificial intelligence-enabled literacy, and strategic advocacy partnerships. From simplifying health insurance to empowering providers through compliance, Peridom has always turned complexity into clarity, bringing forth our values of equity, access, and protection into the future of care. With roots in insurance and advocacy and compliance leadership, Peridom Insights has scaled its mission to prepare the public health workforce and systems for tech-enabled equity-centered future. So thank you so much. Please, let's welcome Kelly. Thank you. Thanks, everyone. Kelly, go ahead.
Testing. Good. So happy, thankful Thursday, everyone. As he mentioned, I am Kelly Dominique Hudson. The purpose of today's Lunch and Learn is to provide context on racial discrimination practices in insurance in a condensed historical timeline. And I say condensed because the history is so rich and so exhaustive that we could be here until next week and still not even scratch the surface. Our aim today, next slide, please. Our aim today is to illuminate the historical relationship between race and the U.S. insurance industry, to uncover how structural racism has shaped both past and present underwriting practices, and to mobilize folks just like you to invest into the next generation of equity-driven system designers. So I'll begin with a quote. Race was never a risk. It's not a diagnosis. It's not a behavior. In fact, it's not even real. But systems made it a real risk, not through science, but by design. Institutions structured inequitable systems built to codify bias. And once codified, it became policy, written, priced, and enforced. Next slide, please. All right, who can name this brand? Anyone in the room? Who can name it? Dunkin' Donuts? Okay. All right, so does anybody remember their tagline?
It runs on Dunkin'.
America runs on Dunkin'. Okay, next slide, please. So America runs on Dunkin', that's their tagline. It was introduced in 2006, and it emphasized the brand's commitment to providing not only donuts, but also a range of beverages that fuel people's daily routine. Next slide, please. They could be onto something, right? I mean, this was their stock price when I created this a couple of days ago. Their annual revenue was 1.4 billion, which was reported in 2019. In terms of coffee dominance, they serve over 1.9 billion cups of coffee per year, right? And their employee count is over 250,000 employees, which was reported in 2022. And in terms of global presence, they have more than 12,000 locations in 36 countries. Next slide. All right. So if American runs on Dunkin', let's decide some things or talk about some things that you can actually do without Dunkin'. Okay. So you can buy a car without Dunkin'. You can travel internationally without Dunkin'. You can age and plan for your retirement without Dunkin'. You can buy a boat, purchase a home, start a business, get some of those electronic devices that you enjoy. You can even rent a waterfront property without Dunkin'. Next slide, please. But what happens when you get into a car accident or your business suffers from a cyber attack? Or you're like me and you broke your phone screen? What if the kiddos get sick or they need to go to the dentist? Or you missed that flight for that international trip you've been planning for months? What if in that home you just bought, the pipes burst, or there's a flood near that waterfront property, or you leave a job? Who are you gonna call? I thought for sure someone was gonna say Ghostbusters. And no one said it. You gonna call Duncan? Right? Next slide, please. So the question is, does America run on Duncan? My answer is nah. America runs on insurance. All right. Next slide. So now we have a quick 2-minute exercise. All you need for this is a sheet of paper and an ink pen. There should be supplies at every table. All right. Next slide, please. Is everybody ready? All right. Can I get someone to set a 2-minute timer for me? Cool beans. So the name of this exercise is called How Insured Are You? So I want you to list the different types of insurances that you have. What types of insurance policies do you have currently? And if you are attending online, feel free to grab a sheet of paper and something to write with to just, okay, yeah, or you can put it in the chat, exactly. Slide. Not next slide, but we can stay on that one. But just hold tight for the 2 minutes. I don't know how much time we have left, but just take your time and think through. No pressure. There is a prize at the end of this. All right, coming down the pike. Next slide, please. Oh, actually, go back, go back. My apologies. All right, so who thinks they have the most policies? If you could take time to count to see how many you have, what numbers are coming up online.
Somebody online with 8 policies, another person with 5.
Okay, somebody online with 8, another one with 5. What about someone here in the room? 9? 10? Okay, anybody can be 10 here in the room? All right. So we have a prize for the person who has the most policies. You could, next slide, please. So this is a list. It's not an exhaustive list, but it is a list of all the different types of policies. You're welcome. I want you all to take a moment to kind of digest what you see here to see if there is anything that surprised you, either about the number of policies or the type of policies. I know for me, what was surprising, where is it? Oh, there it is. Underneath specialty and other, kidnap and ransom insurance. I never knew.
Climate insurance.
Climate insurance, okay. Anything else that kind of stood out to anyone else in the room?
Yeah, ride share insurance.
Okay, ride share insurance, yep. Okay, we can move on to the next slide. All right, so now that we've demonstrated how much insurance has sort of infiltrated itself throughout our lives, right? No matter what you do or where you go, there's a policy that can help with that. So let's talk about insurance at its core and what is it really? So if you think about insurance, you could say that risk is the raw material of insurance. You pay a premium to transfer the risk to an insurer who promised to pay in the case that that the risk occurs. So the Maryland Insurance Administration, which is the state government agency that oversees and regulates insurance in Maryland, they emphasize the role of insurance as managing risks that cannot be eliminated. And according to the MIA, while it's not possible to eliminate risk arising from poor health or auto accidents or home damage or any other unexpected occurrence, individuals can minimize that risk or minimize that impact by purchasing insurance coverage. Over here for our left at the bottom, that's the newest commissioner of the Maryland Insurance Administration, Marie Grant. Um, she's been here less than a year. She's a predecessor of Commissioner Kathleen Bahrain, who she was appointed by Hogan. So the National Association of Insurance Commissioner, which is one of the oldest regulatory bodies of insurance, they highlight the role of insurance as a means of protection from financial loss, right? And they believe that it's a form of risk management, and it's primarily used to hedge against the risk of contingent or uncertain events. Next slide, please. All right. So I want to read through all of this. You can, kind of read through, but the main thing that you need to know is that insurance equals risk management, right? So we talked about how it's transferred from an individual or an organization to another organization in exchange for premiums. And so another key note is that if you don't pay the premium, your policy isn't in force, right? I want to skip down to where it says it's spreading the cost of unexpected events across a large group. That's important as well because all of your premiums kind of go into a salad bowl, if you will, to kind of spread the risk around. Oh, also, the very last bullet, that risk is the chance of a chance or possibility that a peril will occur, right? And so the peril is the cause of that harm. It could be a flood or a fire or what have you. And then on the right, you have some fast facts. That's good to know. The bottom one is probably the more pertinent one, is that every state has their own commissioner of insurance. And so it's not a federally led um, or federally governed entity. Insurance is managed from state to state in the district, of course. Next slide, please. All right, so um, these are ways that we as humans manage risk. So there's several that are outlined here. We have risk avoidance, which sounds like what it is, right? It's choosing not to engage in a risky activity. So like not going skiing to reduce the risk of you like breaking a leg, right? And then we have risk reduction, which is taking steps to lower the chance or the severity of a risk. So this could be something like, wearing your seatbelt, just in case you get into a car accident to reduce the risk of self-harm. And you have risk retention, where you accept the risk and pay for the cost yourself. So I'm sure you all have probably had some sort of, like in your home, you had something break, and instead of filing a claim, you just go ahead and pay for it out of pocket, or something happens with your car. Or a health-related example is not having health insurance and relying on the emergency room for care. Risk transfer, which is what we've been talking about here, passing a cost along to someone else. And then risk sharing, which is, again, spreading the risk across a larger group. And an example of that is if you and your coworkers are a part of a group health plan and the premiums that you pay are pooled across so that everyone shares the risk. Next slide, please. So we have a little quiz here based on the ways in which we manage risk as humans. Which of these best describes what insurance does? If you're online, you can put it in the chat. And if you're here, you can just kind of say it out. No wrong answer here. Okay, risk transfer risk. Anybody else? Okay, next slide, please. Oh, it's not highlighted, but it's D, right? It's transfer, risk transfer. All right, next slide, please. All right, so risk-based pricing, discrimination by design. The gentleman in the back, you and I, we were talking when you first came in, and you were saying, we're talking about it should be, right? In essence, insurance discriminates by risk factors. And so if we're still thinking about risk as the raw material of an insurance contract, and the policyholders, they transfer risk to the insurer for a fee, which we discussed called a premium. The insurance premiums are determined based on an policyholder's expected loss. And because insurance is about risk factors and risk pricing, it naturally differentiates, right? It naturally differentiates risk types. So this means that policyholders are not charged the same thing. So by nature, insurance aims to be discriminate. Next slide. All right. Mutual aid as a form of survival. So long before risk pricing or risk transfer, and even before insurance became an industry, mutual aid was already a practice and cultural tradition rooted in survival, dignity, and the collective care of the community. Mutual aid is a voluntary system of cooperation, exchange, and the collaboration for a common benefit. Next slide, please. All right. So at its core, mutual aid is a risk-sharing partnership that predates modern society. People have worked together to survive for all human history, and it's where all participants bear a portion of the loss, which reduces the individual's burden. Next slide, please. Peter Kropotkin, the 19th century Russian aristocrat turned anarchist, he wrote about this in his 1902 work, Mutual Aid, a Factor of Evolution. So he writes that the mutual aid tendency in man has so remote an origin and is so deeply interwoven with all the past evolution of the human race that has been maintained by mankind up to present time, notwithstanding all the vicissitudes of history. Next slide, please. So mutual aid, not as a need of necessity, but as a form of resistance. And so what happens when people are denied access to risk transfer, not just once, but generation after generation? Well, when you're denied access to protection, you make your own. Next slide, please. So mutual aid has been a form of resistance and it has deep roots. So let's together go back to 1693. In a 1693 diary entry, Cotton Mather wrote, "A company of poor Negroes, all of their own accord, addressed me for countenance to a design they had of erecting a meeting for the welfare of their miserable nation that were servants among us. I allowed their design, and I went one evening and prayed and preached with them and gave them a set of rules, which I insert for the curiosity of the occasion." So in his recording, he demonstrates how Black people were practicing risk sharing out of necessity long before insurance companies would have insured them. But let me be clear that Cotton Mather was no champion of Black liberation. He was a Puritan minister, a man who upheld colonial systems of power, including enslavement. He believed that enslaved Africans should be saved through Christian conversion, but this salvation was bound by obedience, labor, and suffering. Yet in his 17th century diary entry, he acknowledged that a group of Black Bostonians that he referred to in his excerpt as poor Negroes came to him on their own accord, not to ask permission, but to seek visibility for creating a society for their own welfare and betterment. Next slide, please. So even in colonial America, Black communities have always resisted with structure. Black Bostonians, some who were formerly enslaved and most excluded from every formal system of protection, still organized to protect one another. They formed the Society of Negroes. Do you hear that? Kind of sounded like a little background. Can you hear? The charter you see here on the left is attributed to Maynard, who penned the rules for the Society of Negroes in 1693. Next slide, please. All right, so what we'll see is with evolution, we'll go from sort of risk sharing and mutual aid to risk transfer and the commercialization of insurance. Next slide, please. So I know it's a lot here on this timeline, and I don't want you to be overwhelmed by it. As we move through it, I want to emphasize that this is not a comprehensive history, that we're only focusing on key events and trends that illustrate how racial discrimination has shaped the insurance industry. So you can think of this as critical snapshots that help us understand the bigger picture and historical events, including the 1964 Civil Rights Movement or the Fair Housing Act of 1968, are out of scope for this presentation. So this session is focused not on the legal remedies that came after injustice, but on the systems that created it. And by centering the early architecture of racialized risk, we can uncover how discrimination was not just social or political, but deeply structural, economic, and actuarial. And so understanding the foundations is essential to reshaping the future of insurance and equity today. Next slide. All right. So how many people here have heard of Lloyd's of London? You can either type it in the chat, yay or nay, kind of raise a hand here. So most people have heard of Lloyd's of London for insuring popular culture icons. Gene Simmons, the front runner of Kiss, insured his tongue for like $2 million. Will Smith insured his bungee jump over the Grand Canyon for $200 million. Rihanna insured her legs for $11 million. I think Julia Roberts insured her smile through Lloyd's of London for $30 million. Right. And I also found while doing this research that Lloyd's of London insured the Titanic before its shipwreck in 1912. But as early as 1688, the insurance industry was underwriting slavery. Lloyd's of London made it profitable to traffic human lives by offering policies that traded Black bodies as cargo. Lloyd's of London and the insurance industry at large was not just complicit in the transatlantic slave trade, it was the financial engine behind it. Lloyd, um, Lloyd's insured enslaved people and the slaving ships. And in the 17th and 18th century, Lloyd's underwriters routinely insured ships carrying enslaved African cargo. These policies covered slaving ships themselves, the loss of enslaved people due to death. There was a clause, however, that created an exemption for disease, right? So if you perish from a disease from the conditions on a slave ship, you wouldn't be reimbursed for that. It was considered uninsurable. But they also provided insurance against a rebellion, essentially treating Black life like property and a liability. Lloyd's helped standardize slavery as a calculable risk by developing precise actuarial methods to assess risk of insuring slave voyages. This included mortality, expectation, voyage routes, uprisings, all logged and tracked like any other commodity. Lloyd's profited and legitimized slavery as an insurable enterprise, and their policies helped to fuel the financial growth of the British Empire. Next slide, please. Actually, no, go back for me. Okay, so if you look at this document at the bottom of this transatlantic slave ship map, you can see that this agreement is spoke about the value of the ship, which is 3,500 euros. And if you kind of go to that highlighted section, you can see where each slave was valued at 45 euros. Next slide, please. So it wasn't just international major players insuring human traffickers in their vessels. Major US companies were involved. Companies like, can you go forward one slide for me, please? Okay, go back. Back one more. Okay. Go forward, it's fine. I'm gonna just skip to that one. Notes a little bit out of order. So this is key because it talks about um, the Lloyd's of London, one of the ledgers that they found. So this is fine. I'll just pick up here. So an independent research group based at Johns Hopkins University was granted access to the Lloyd's archives in order to delve into the financial history of the slave trade. At Lloyd's, the researchers found records available nowhere else in the world, including the 1807 risk book of the prominent London underwriter Horatio Claudette. Now, if you work in insurance or you're a broker, you know that your book of business is your bread and butter, right? And so for Claudette's book of business, it described coverage of hundreds of voyages for 59 slave voyages, accounting for more than 1/3 of all known slave voyages departing Britain that year. So that's 1 year of with 59 slave ships that were insured. They also found detailed policies listing the terms of each slave voyage and individual underwriters who would assume the risk or share the risk. So some of the coverages included vessel damage caused by slave insurrection, which affected about 1 out of every 5 voyages. And if the cargo was covered as well as the ship, each captive was assigned a value payable even in death. Next slide, please. All right, this is just a zoomed in view of that document that they found it within his ledger. Next slide, please. All right. So again, it wasn't just the international major players like Lloyd's of London. You had some US companies who were involved. some of which who we still know and probably are insured by today, like Aetna, New York Life, the Baltimore Life Insurance Company. They all had policies for enslavers. Okay, New York Life admitted in the year 2000 that it had issued at least 485 policies on enslaved people, naming the enslavers as the beneficiary. Next slide, please. And this is another zoomed in view. If you want to look at this policy was valued at $500,000, written by Aetna. And if you look at the bottom, it says clearly Negro insurance. Next slide, please. Indemnity for the enslaver. So indemnity means to make whole. That's the promise that an insurance company makes to you in exchange for the payment of your premium. Before freedom came to most, U.S. insurers had already profited from slavery, and in 1862, the government continued that pattern by compensating enslavers for their loss. So the District of Columbia Emancipation Act, which occurred in 1862, they paid loyal Union slaveholders up to $300 per freed person. Meanwhile, formerly enslaved people received nothing: no land, no compensation, no insurance, no reparations. And to be clear, this wasn't insurance, but the payout or the indemnification used its same logic. Next slide, please. So indemnifying enslavers for their loss didn't just pay a debt, it definitely set a precedent, right? That Black freedom was a financial inconvenience and Black life was a depreciating asset. In 1881, Prudential declared that life insurance policies held by Black adults would pay 1/3 of those for white policyholders. I'll state that again. In 1881, Prudential declared that life insurance policy held by Black adults would pay out 1/3 less than those of white policyholders, despite both groups paying the same weekly premiums. For children, benefits remained the same, but premiums increased by 5 cents, reinforcing a racial pricing gap. And Prudential justified the changes using racially based mortality data to claim that Black people were a higher risk group, a tactic we now recognize as scientific racism applied to financial products. Next slide, please. So what were the implications of that, right? What were the implications of this precedent set by Prudential? So number one, it codified racial risk in pricing. And this was one of the earliest formal declarations that race itself was considered a risk factor. It also created a dual risk system, right? So you had dual risk rate books, pricing manuals for Blacks, pricing manuals for white customers, and that persisted well into the 20th century. Thirdly, it stripped Black families from generational wealth tools. Life insurance was and still is one of the few financial tools available to working class families to build intergenerational security. These pricing disparities meant Black families got less for the same money, reinforcing systemic wealth gaps. And last but not least, it deepened distrust in institutions. These practices contributed to a longstanding distrust of the insurance industries in Black communities, a distrust born not from myth, but from lived experience. Next slide, please. So we talked a little bit about the National Association of Insurance Commissioner earlier. I call them NAIC. Some people say NAIC. Um, they date back to the 1800s, and they met in 1912 at a convention. And so they quickly noticed that over time, race-based pricing became a standard across the industry. During that convention, one of the commissioners addressed the absence of clear and unfair insurance terms, especially in societies collecting small but frequent payments. They noticed a regulatory abuse by some of these fraternal societies and the exploitative business models aimed at Black policyholders. Next slide, please. Actually, I'm gonna read it. Go back. So it says this is documented in the notes from the convention. It says a great deal many associations and societies are run for the benefit and too often prey upon the Negro. Small sums are collected weekly with the promise of sick and death benefits. And I need not say we have many complaints. Recently, an old colored man came in to have his policy examined. He was told what he was to pay on each policy and what he would receive in case of sickness or death. He said he understood it. He said he understood it all that way. And when he was asked what was the trouble, he replied, Lord boss, I want a policy with some destination to it. People are generally beginning to feel very much like old darky, saying that not only were Blacks targeted, but even whites were targeted with some of these sort of biased conditions in insurance policies. Next slide, please. So in 1940 and 1920, there were 42 Black-owned insurance companies, which I did not know that prior to doing research for this presentation. It was a fun fact. Despite inequity barriers, as early as 1890s and into 1920s, Black communities built, right? Black-owned insurance companies emerged not because they were shut, Black insurance companies emerged because they were essentially shut out of the marketplace. These institutions weren't just businesses, they were lifelines, and they made coverage possible when no one else would insure them. Next slide, please. We have the 1921 Tulsa Massacre. Um, so the Tulsa Massacre was one of the most significant racial terror events targeting Black prosperity. And by 1921, Black communities like Greenwood and Tulsa, Oklahoma, they weren't just surviving, they were thriving. They built banks, businesses, homes, and yes, many had insurance. But when white mobs burned it down over the course of 18 hours, the system failed them again. More than 1,000 homes and businesses were destroyed. Tulsans suffering losses, Tulsas who suffered losses because of the massacre filed 1,400 lawsuits over and experienced over 4 million in property loss. I'll read that again. Tulsa suffering losses, Tulsa suffering losses because of the massacre. They filed 1,400 claims worth over $4 million in property loss. However, the city leaders of the time characterized the massacre as a race riot. And so they ended up denying the claims. Over 95% of the claims that were filed at that time were denied. On the right here, you have a picture of Mother Fletcher or Miss Viola Fletcher. She is the oldest known living survivor of the Tulsa Massacre. I believe she just turned 111 last week. Next slide, please. So the denial of insurance claims, they left the community devastated with no choice but to use any savings and capital they had left to rebuild on their own. This is what racialized risk looks like in real life. And when loss happens, Black policyholders they were told that they weren't covered. And then a decade later, that logic of denial became a national policy. And then we began to see the rising of redlining. And so if you've never heard of redlining, the National Housing Act of 1934 created a federal housing administration, and the FHA, through the Homeowners Loan Corporation, began grading neighborhoods by risk. Neighborhoods like Greenwood, they would have been deemed down here at this bottom criteria as undesirable. But let's walk through. So Type A, which would be green, and we'll look at some maps in a minute. It meant that the area was like an affluent suburbs, could be like Chevy Chase, but there's the Potomac, that sort of neighborhood. Type B would be colored in blue, which neighborhoods that were still considered desirable. Type C, which would be yellow, would be older neighborhoods that would be labeled as declining. And type D would be red, that were generally older inner city neighborhoods considered most risky for mortgage support and undesirable. Next slide, please. All right, so I hate to throw a lot at you, but I really wanted to show everything that's here. So here you see Maryland red line maps, specifically Baltimore, to your at the top of the screen from center, I would say. You can kind of see the legend that describes these areas as either best, still desirable, definitely declining, and hazardous. So you can also see Boston here, which is right here. You can kind of see Boston. And this one is a New Orleans map. And I think all the way to the bottom left is an Atlanta red line map. The FHA underwriting manual was used by lenders if they wish to secure federal backing for loans. The FHA appraisal manual instructed banks to steer clear of inharmonious racial groups and recommended municipalities enact racial restrictive zoning ordinances, which is what you see here. Next slide, please. So while states like Maryland, we did have red line maps in Baltimore, here in Montgomery County, you didn't really see a lot of that redlining. However, what we did have was racial restrictive covenants. So the federally sponsored redlining limited the ability of Black homeowners to accumulate wealth through housing. In 2022, Montgomery County's Planning Historic Preservation Office researched the history and the effects of discriminatory housing practices in Montgomery County. You can kind of read a few snippets for yourself. So the first one at the top says, no person of any race other than Caucasian race and no person of the Negro or Mexican race shall use or occupy any building or any building, any lot, except that this covenant shall not prevent occupancy by domestic servant of a race domicile with the owner. So you could employ someone as a servant, right? And they could even live with you. But if you were a Black person who wanted to buy or rent, you were essentially shut out. There was also this sort of restrictive covenant amongst realtors. Kind of skip down to, it says, a realtor should never be instrumental in introducing into a neighborhood a character of property or occupancy members of any race or nationality. I won't read the other one because it's a lot to read, but they were very exhaustive in who they didn't want in. So it wasn't just, you know, Black folks, it was Asian folks, Jewish folks, Armenians, Greeks, Persians, Syrians, Turks. Um, they were very decisive in who they didn't want in. So these snippets from the advertisement that you see here highlight the pervasiveness of racial discrimination in Montgomery County real estate and building practices well into the 20th century. Next slide, please. All right, so you're probably wondering, where's the tech stuff? We've evolved, right? So a lot of the ways that we do insurance was paper-based, of course, by way of the times. And so essentially, we've evolved to technology. And with that, we discovered that there is also algorithmic bias in insurance, right? So it's human bias in disguise. So the restrictive covenants that we saw in Montgomery County made exclusion explicit, but today, algorithms do the same, but silently. What we've witnessed so far is how risk became color coded, right? Color coded bodies and color coded maps and coverage. Now let's explore how risk has become the code itself, right? Through zip codes, credit scores, and algorithms. These all became the new language of discrimination. Next slide, please. So I just want to level set here at a 3,000-foot level to give a definition of artificial intelligence. And this definition is from the NAIC. So I just wanted to create a little guardrails around this definition because it varies. It can be exhaustive at times. So I just want to kind of bring it down to a very basic level. But essentially, artificial intelligence is described as a branch of computer science that uses data processing systems that perform functions normally associated with human intelligence, such as reasoning, learning, or self-improvement, or the capability of a device to perform functions that are normally associated with human intelligence, such as reasoning, learning, and self-improvement. Next slide, please. So I want to be clear that ensure that the issue isn't the data, right? So when we think about algorithmic bias, the issue isn't the data, it's the logic behind the data. And so when we think about bias, if bias is when someone or something unfairly favors certain people or groups over others, then what are algorithmic biases? They are the lack of fairness in the output generated by an algorithm. These biases may include age discrimination, gender bias, and racial bias. Next slide, please. So these are some very current case studies about AI bias or algorithmic bias. And I've placed a QR code here for you to take a snapshot if you're interested in diving deeper, but essentially it discusses algorithmic bias over various lines of business and insurance. Next slide, please. All right, let's start with the 2025 KPMG Unequal Odds Report, which it examined how bias manifests in life insurance modeling and underwriting. One of the key findings is that AI-driven insurance models often unintentionally target minorities in areas such as health, socioeconomic status, gender, and geographic location. In some case studies, life insurance models associated with socioeconomic status with high risk. This resulted in higher premiums from applicants from poor backgrounds. Next slide, please. When we look at the 2025 Casualty Actuarial Society's research papers, they examined the influence of racial bias in insurance pricing. One of the key findings is that the use of credit-based insurance scores can disproportionately impact communities of colors, and the research calls for a reevaluation of such factors to ensure fairness and mitigate potential biases in insurance underwriting and pricing. Next slide, please. So Delu also has a global health output report from this year, and in it, they examine inequities in health insurance practices, such as risk management and premium setting. They found that AI-driven health insurance rested on biased algorithms. By one, they not only reinforce those existing biases, but they also affect equitable access to coverage by discriminating in pricing and coverage decisions. Number two, they found that the bias led to gaps in preventative care by either under allocating or over allocating resources for managing chronic conditions prevalent in certain racial groups, which perpetuates health disparities, particularly because these chronic conditions are often more driven by social determinants rather than genetics. Next slide, please. The 2024 Society of Actuaries Institute, their report highlighted that while AI improves the precision of underwriting, it also introduced risks of biases if not carefully managed. And it sort of creates a double-edged sword of AI underwriting. Just to unpack a little bit, when we talk about insurance underwriting, the term underwriting means evaluating and assuming financial risk in exchange for a payment. Um, a few of the things that they stressed in their report is that while AI improves the precision of underwriting, it also introduces risk, and it expressed the need for data diversity, whereby AI systems must be trained on representative data to prevent skewed decision making. And it expressed a great need to create AI-driven underwriting models that are both effective and socially responsible. Next slide, please. All right, so these are a plethora of factors that contribute to algorithmic bias in AI system, but the one that you probably should know is bias train, bias training data. So all of the AI tools, or most of the AI tools that people probably use, right? ChatGPT, Claude, Perplexity, Chat PDF, like all of the things, they are trained based on data. So as you're working with it, you're essentially training it. And so bias training data is historical data that often reflects societal biases, stereotypes, or systemic inequities, which can be unintentionally encoded into AI systems during the training phase. Oh, I have a cool example. It says an insurance company uses AI algorithms to determine car insurance premiums for policyholders based on historical claims data. The training data predominantly consists of claims data from urban areas, leading to overrepresentation of claims from city drivers. The data lacks sufficient data from rural areas and underrepresents low-income individuals, and thereby the premiums will be based on this bias that's inherent in the system for which the price is rendered. Next slide, please. All right, so this is like kind of like a process flow in the way in which consequences occur with algorithmic bias. So you start with the risk classification, and then you move down to bias data. And then based on that bias data, you end up with cost discrepancies. So you end up overcharging or undercharging or having adverse selection. Next slide, please. So one thing that I found that there were commonalities amongst all the reports, right? So these are the 4 consequences or commonalities from all the reports that I read as it relates to algorithmic bias. Number 1, that the data reflects society's biases. Insurance models learn from the data that they may Insurance models learn from data that may include societal unfairness affecting how people are treated. Models unintentionally target minorities. Algorithms can unfairly associate zip codes, ethnicity, or income with higher risks, leading to discrimination. Number 3, bias gets worse over time. So garbage in, garbage out. These models can reinforce existing biases, making unfair decisions more likely. And these aren't just numbers, they have a real impact on people. Minorities and lower income groups may face higher costs or denials of coverage unfairly, showing the need for fairness checks. Next slide, please. So the arc of this conversation is that race was never a risk, right? But our system made it one. From the first fire policies to today's AI underwriting, the insurance industry has long measured risks in ways that devalue Black life, not by accident, but by design. What started as mutual protection and risk sharing evolved into commercialized risk transfer. But along the way, risk became color coded, first explicitly, then statistically, and now algorithmically. We've insured property, bodies, and future, but too often denied protection to those most in need of it. Mm. Essentially, essentially now we stand at a crossroads, and the question becomes, will we allow past injustice to be hard-coded into the future, or will we finally ask, what if protection wasn't just privilege, right? What if protection wasn't just for the privilege, but a tool for equity itself? All right, next slide, please. All right, so what do we do now, right? Now that we're here, what can we do to rewrite the risk equations, right? So number one, we can build a pipeline in actuary science. It's a field predominantly held by whites. You don't really see minoritized groups majoring in actuary science. So we should encourage our Black and Brown scholars to explore actuarial science or data ethics. We can expose the system. We make folks aware and communities aware of how risk has been racialized and why it still matters today. We can develop algorithmic literate leaders. We can invest in tech fluencies and partner with organizations who can design, audit, and challenge biased systems, not just use them. We can get civically engaged. When I was partnering with the MIA earlier this year, I noticed that they have a committee on race and insurance that is open to the public. So if you feel inclined, you can join those and allow your voice to be heard. And then lastly, we can honor the legacy, right? We can build with the same courage as those who created mutual aid societies and groundbreaking insurance companies from exclusion, and then pass that blueprint on to the next generation. So for Paradigm Insights, how we're getting into good trouble, as I like to call it, we are educating communities on historical and modern systems that shape access to protection, care, and equity. We are equipping change makers through culturally relevant training in health literacy, AI ethics, and regulatory accountability. And we are empowering the next generation to not just navigate biased systems, but to rebuild them with justice at the center. Next slide, please. All right, we made it to the finish line.
Thank you so much. That was so insightful. Thank you so much, Kelly. That was great. So please, if anybody, we have time for a couple of questions. Anybody here in person, and if you are on in Zoom, you can post your questions on the chat, and Anthony will relay to the speaker. But I just wanted to say, just wanted to make commentary. It was really, really great to see how, we were all aware about, racism and all that, but how it became from being overt and how technology has allowed it to now become covert. And we talked a lot about technology here at the Hub, and we'd like to point both aspects of technology, the good things that it can do, but also how it can be used for how it can be better used. And thank you, that was great. So I think that we have a question here.
Yeah, I'm actually an actuary, so I'm really glad to hear something about this. I'm working on flood insurance risk. So my question is, so we talk about the history, and nowadays, right now, do we have very concrete evidence that any insurance actually have racial biases? And is there any lawsuit about it? Something, do you ever heard about it?
Thank
So just so I want to make sure I understand your question. Your question is there any evidence of algorithmic bias and is there any sort of lawsuits? for right now, I'm not aware of any current lawsuits per se as it relates to algorithmic bias. As you know, AI is on the frontier, is ever changing. A lot of the tools that we use are constantly being updated. And so what might be an issue for today may not necessarily be an issue for tomorrow. I haven't heard of any sort of lawsuits per se, but there is a large body of folks who are in AI governance, which we're working to create some guardrails around this thing because it's essentially the wild, wild west. And so there is a body of people who are working to be ethical and to use AI responsibly.
General, when we try to validate knowledge,
Mhm.
there is one of perspective is we have to pass this kind of compliance regulatory compliance.
Okay.
That we have to make sure there is no sacrifice.
Okay.
But if the companies may have different ways.
Mhm. What are you seeing? I mean, you're an actual actuary, so what are you seeing from your perspective that, communities should be aware of in terms of how technology is used in insurance?
I think the point you raised at the end. I think the point you raised at the end is definitely very beneficial. So you listed like 5 things we have to bear in mind nowadays. I think they are very crucial. They are very crucial. I mean, definitely for all the insurance providers, they need to put this into practice for sure.
Thank you.
So thank you. That was very educational. I've learned a lot today. So my comment is that certain insurance fees we see like associated with dental or vision is very clear. There's only one fee associated with anybody who wants to join. But there are things like house insurance and car insurance is very murky. So without a true understanding of how to determine what is the dollar value of your house or how to determine those values, it's very difficult for us to even perceive any bias, because my husband and I, when we go get an insurance quote, it just said, this is what you need to pay. There's never, I mean, there's broad cases of like what you like based it on your house but a lot of the fine details, there's no way for us to determine if it's a true cost or not. So very difficult.
Thank you.
No, thank you for your question. Couple of things that kind of fired off into my mind. So what you're talking about is price transparency. And so there are a couple different initiatives that are happening in terms of making the price more transparent. Also, you have your explanation of benefits. So when you get that in the mail, it gives you an explanation of what you have. And a lot of people are overwhelmed by that because a lot of it's written in legalese. But one thing I can say about Maryland at the MIA's website, they have a plethora of different tools and resources that you can use to better understand your plan. They also have hotlines that you can call. So let's say you have health insurance and you're not sure how to read your policy, or if something is covered, you don't want to go out of network, you want to stay in network, you can call the number that you find on their website and a live person will help walk you through. So even though policies are still kind of written in a complex way, there are resources out there to help you navigate.
Thank you. I think we have one more question here.
Yeah, it's actually two-part. One's follow on to what my wife said. Yeah, so for house insurance, it jumped tremendously because the explanation I got was it jumped because Maryland Insurance Agency or Commission allowed this to be repriced and jumped up. And then when I called the insurance company, they said, well, we used an older rate, which has a higher pricing. So they switched me to a newer rate factor that had lower pricing. And I was able to get that jump reduced. It still went up by about 15% over a 1-year period. Right? So that's a tremendous jump. So, but my real question is actually garbage in, garbage out. Right? So you mentioned that. So in your estimation, how long will it take for the garbage data to be sorted out and filtered?
Good question.
Necessarily know that I have the answer to. So I'll comment on your first question first. So anytime you have like a price hike or any sort of discrepancy with any line of business insurance, you can file a complaint with the Maryland Insurance Administration. I did this while I was partnering with them. I was on a contract with them, and then I filed a complaint. But they'll investigate it for you. And the good thing about it is while they're investigating, it keeps your policy in force. So you don't have to make that decision about whether you want to jump to another insurance company just yet. They'll do everything on your behalf, and then they'll call you back in if they need more details, and they'll give you the final decision. But it's good to have them working from the inside on your behalf. So next time you ever experience that issue with any line of business, you can file that complaint. The second part, I don't necessarily have an answer to that because I feel like there's so many moving parts to it, right? So you have some people who are tech heavy, then you have some people who are slow adopters to artificial intelligence, and then there's the digital divide. And so I think it's going to take more regulation, but that changes with administration. I feel like we are in an arms race with regards to AI. Everybody is trying to build the next big and better tool. That's one that I'll have to put in my back pocket and do a little bit more research on.
Thank you so much again to everybody that attended this meeting and for your very thoughtful questions. Thank you so much. It was thank you so much again, Kelly. Let's give her a round of applause. Thank you. Thank you so much. So as we wrapped up for our in-person guests, we will be moving shortly to 101 to share lunch. And again, I need to mention that these community meals for our guest speaker series are provided by Verizon, who's our sponsor for this series. And I would like to tell you what is coming up with the hub. Like I mentioned before, this is our last Future of Tech, and we wrapped up. This is our last actually event for our guest speaker series for the spring 2025. In the summer, we are quite busy with our Montgomery Kent Code Summer Camp. And again, this may not be of direct interest to you, but you may know somebody, maybe your children, your grandchildren, nephews, nieces, neighbors that may be interested in this. Registration is open. We still have a lot of seats open. We have this year expanded the program again, and it's going to be offered at 4 Montgomery College locations in person and also virtually. Is a free 1-week coding camp for any rising 6, 7, or 8 grader that are in the Montgomery County Public School System. So a great, great opportunity that is free and is super fun for the kids. We're also going to have some of our career workshops during the summer, and in the fall, we resume again with our guest speaker series, our boot camps, our digital marketing course, and a couple of other offerings that we're still working on, and we will let you know as soon as they are become solid. Again, thank you. Before we leave, I would like to remind everybody that our guest speakers are volunteers. They don't get paid to be here. They come here and they share their time and their knowledge with us, and we really truly appreciate that. And just so at least a very small token of our appreciation. Thank you so much, Kelly, for being with us today. And again, before we leave, as always, we're going to ask both our attendees in person and online to complete the event survey. Anthony is putting our QR code for the people here in person and also for the people online, and he's also going to post the direct link on the chat. Take a minute or two to complete this. We really, really take a look at this. We will share the results of your comments with our guest speaker, and it really helps us, program what this comes next for the hub. We really take a look at this. Our director really is very high into looking at this data to make the programming for the next season. And once again, I would like to thank everybody, especially our repeat guests that have accompanied us to different events during our guest speaker series in the spring, and hope to see you in the fall. Thank you so much for the people who join us online. I hope that you have a great rest of your day. And thanks again for choosing to share your time with the Ignite Hub. Thank you so much. Have a wonderful day. Thank you.